Good afternoon, everyone. Stock Market Sage here, going over the stock market cycles from trough through sectors, average of the last four market declines of over 15% through November of 2008. And we had looked at what was leading the market once it was down over 15% and started to recover. What areas? And as you can see by this chart, as we led up to the trough, we also have what was down the most. And you could also see that it's kind of not coincidental that utilities were the safe play when things were getting terrible, and then as things hit bottom, utilities also had the least recovery. So least downside, least recovery. As once we hit a trough, you can see the things that shot up led the way for the recovery or information technology, which of course is tech, very high PEs, a lot of room for expansion, very popular investment, in the news a lot, followed by early recovery. You're seeing telecom services, which is kind of rides technology's coattails now. And then of course financials up here, strong recovery, not quite as much as tech, but certainly a very strong second place. And as we talked about in a free video, utilities had a recovery, very safe, nothing to kind of sneeze at. Now, what are some of the things we're seeing in this current end of '08 turning into '09, and why might it be different? And maybe you don't want to follow this chart. First thing I'd like to point out to the subscribers is that the financials, this cycle is different from maybe any other. And I certainly hate the phrase, it's different this time, but certainly with the financials, the things that are taken away, leverage. No longer can the financials, the Goldman Sachs, the Morgan Stanleys, Lehman's not even around, Merrill Lynch isn't even around, they're now Merrill of America. The leverage needed to create large bull rushes in this sector is gone. It's going to be scrutinized, it may never return. No longer can companies leverage themselves 30, 35, 40 to 1. And for those that are new, that means they would have an asset and borrow and invest against it, not 1 to 1 as collateral like most of us are 2 to 1, but they actually, laws were allowed to allow these companies to invest up to 40 to 1. So that would be like you having a piece of a car, let's say it, and you put it up as collateral in a bet or for a loan. Only you were allowed to get 40 loans equal to that car's value over and over. And you can see that they leveraging, and with the TARP bailout, with the bank holding companies now taking over the financials, no longer there are laws in place that don't allow the leveraging. You don't have that massive explosive growth. Financials should be renamed banks. Banks are nice stocks, churn out a dividend, strong performers, very stable. So you may not see financials up in this sector when we rewrite this chart in a year or two. The other thing I wanted to point out is energy. Certainly energy has had a very big headline effect in the last 2 years. Has about, as you can see here, some decent recovery, 17, 19%. The price of oil and how it's been manipulated by hedge funds, black swan money. No longer, since energy is a commodity, it isn't a supply-demand issue anymore. It's a trader's market. There's no rhyme or reason why oil went all the way, to the high 140s, 150s, and then now back into the high 30s. It's something that isn't stable in the sense it's not going to react the same ways. And utilities, we talked about it in the other video. What was thought to be a very safe area to hide for dividends, one, utilities are generally very leveraged. They have a high debt ratio because, as we assume, most people will at least pay their power bill, so banks are willing to let them leverage or take on debt. We are seeing signs here, we're talking the end of '08, where people have not or are late on paying their utility bills, and I mentioned it was, I believe, 1 in 10 recently mentioned in the Wall Street Journal. So again, looking for the explosion, where to be. Is information technology going to be there? Most likely. Technology usually leads us out of areas of slow growth due to intervention and invention. The financials I'd be a little concerned with. Telecoms, the area in red that you're looking at, certainly have a chance to do well. AT&T, Verizon, things like that have a very good dividend and are expanding their universes out of their core product. No longer is it a phone company. It's now a TV, telephony, cell phone, cable, um, do everything type company where you'll have one account like the ATT Uverse system yet to come out, where there'll just be one account for pretty much everything electronic in your life. One thing also to watch out for, a couple tips that you'll see down here: consumer staples and healthcare. Kind of been so-so, not leaders of the pack, but conservative. Remember, this time around for this cycle, we have the largest population of retirees in the history of the planet. So you're talking about people turning 58 to 60 and a massive amount of them. What does that mean? It means healthcare. It means drug companies. It means drug stores. So unlike these other recoveries that they're looking at, the last four market declines, those declines didn't have the baby boomers hitting retirement. So look for a fall of financials in this next chart when as adjustments come out. I would pick financials to be down here. I would pick healthcare to be higher up. And I think you're going to see telecom services, and I would stay away. Energy is just it's too manipulated. It doesn't have rhyme or reason. And if you're the guy at the party asking what's going to happen, then you probably shouldn't be betting on it. And look for the utilities maybe not to have as strong recovery as people actually default on their bills. And obviously the utilities debt levels will most likely be reduced too as credit becomes not only scarcity but also tough to get in the future. So that's the Sage's update on stock market trough sectors, and something to keep how this chart's going to look different the next time around. For now, happy investing.